Welcome back. I'm John A.G. All right, today is not a price show. This is a confirmation show. The levels, the structure, the pressure points, because Bitcoin has reached one of those moments where the chart can look stronger on the surface while the larger question underneath is still unresolved. Today is Tuesday, May 19th, New York time. Drop the day and date you're watching from in the comments. And before we get into it, support the work by subscribing and commenting Our John A.G. if you value this kind of breakdown. So, let's get to it. Bitcoin is sitting in a zone where people are already trying to make a final call. Some are saying the next major drop has already started. Others are saying the recent pullback is harmless and the upside trend is ready to continue. I don't think either side has earned that certainty yet. That does not mean the downside risk is small. It does not mean the rebound is healthy. And it definitely does not mean the market is giving us a clean, easy trade. Our job is to separate weakness from confirmation. That distinction matters more than most people realize, because there is a very big difference between Bitcoin looking tired and Bitcoin proving that the next larger decline is underway. A tired market can pause, it can chop, it can pull back, recover, and then push higher one more time. A market that is actually rolling over starts to change character. It stops bouncing cleanly. It loses support that had been holding. It starts forming downside structure that is difficult to dismiss. And that is the conversation today. Not whether Bitcoin can dip, of course it can. The question is, what confirms that the dip is becoming something more serious? Based on the latest market picture, Bitcoin is trading in the upper 70,000 area, not far from a cluster of resistance overhead, and not comfortably distant from key support below. That positioning matters. When price gets pinned between a ceiling and a floor, traders naturally project their bias onto the chart. Bulls call it consolidation, bears call it distribution. Sometimes both groups are partly right for a while, which is exactly why these stretches become so difficult. Now, the core framework I want to use is simple. The recent rebound can still be understood as a counter-trend recovery inside a broader corrective structure. You do not have to live and die by one wave label to see the point. When a market falls hard, rebounds, and then starts struggling into resistance, the rebound itself has to prove it is more than relief. It cannot simply look better for a few sessions. It has to take back levels, take back momentum, and take back control. Until then, skepticism is not bearish emotion. It is just discipline. And this is where a lot of people get trapped. Corrective rebounds often feel strongest right before they become most vulnerable. Price rises enough to repair sentiment. Comment sections get louder. People who were nervous a few weeks earlier start talking as if the risk has disappeared. Then, just as confidence returns, the market tests a level that matters. If it fails there, the mood changes very quickly. That is why I don't want viewers chasing emotional confirmation. I want actual confirmation. Let's define the first part of that confirmation. Bitcoin has to lose important support with conviction. Not a tiny undercut that immediately reverses. Not one wick that gets bought before the candle even closes. I mean a real break below the lower support band in the mid-70,000 range, followed by weak recovery attempts. If the market breaks that floor and then cannot reclaim it, the bounce starts looking less like consolidation and more like a failed rally. The second part is structure. I would want to see a clean, forceful, 5-wave decline. Or, in plain English, a downside sequence that behaves like a fresh, impulsive move rather than a casual drift lower. Why does that matter? Because a messy pullback can still belong to a larger rebound. A decisive sequence lower usually tells you that sellers are acting with urgency. It says the market is no longer just hesitating under resistance. It is actively changing hands in favor of downside follow-through. And then there is the channel. Bitcoin has been trading inside a recovery structure that is not fully broken down. If price weakens, tests the lower boundary, and then slices through that structure without a strong reclaim, that is a much more meaningful warning than a soft red day by itself. Channels are not magic. They are just a way to see rhythm. When the rhythm changes, you pay attention. Now, I also want to challenge one idea that gets overstated in these moments. A rejection from resistance is not automatically a confirmed top. An RSI rollover is not automatically a confirmed collapse. A moving average test is not automatically the end of a rebound. Those things can be helpful. They can tell you where the market is sensitive. They can warn you that momentum is cooling, but they are not verdicts. Markets can reject once, recover, and reject again. They can dip below an average, reclaim it, and then squeeze the wrong side. If you confuse warning signs with finished proof, the market will punish that impatience. That matters especially now because the macro backdrop is not clean. Recently published inflation data in the United States has remained firmer than many investors wanted, and policymakers have continued to emphasize uncertainty around the path ahead. When rates stay restrictive or rate cut expectations get pushed further out, risk assets often have a tougher time sustaining easy upside. Bitcoin is not a treasury bond, obviously, but in liquidity-driven periods, it can behave like a high beta expression of confidence. When confidence slips, it can slip fast. At the same time, I would not pretend that the institutional side of Bitcoin has vanished. According to the latest publicly available filings, the largest U.S. spot Bitcoin vehicles still hold enormous asset bases even after a rough first quarter. That matters because it tells you demand has not simply disappeared. But here's the other side of that same coin. Those vehicles can also become transmission channels for risk reduction. If investors want exposure, they add fuel. If investors want liquidity, redemptions and hedging can amplify pressure. So the existence of institutional access does not remove downside. It changes how downside can travel. The derivatives market matters here too. Recent market updates have shown an expanding toolkit around Bitcoin volatility, not just Bitcoin direction. That tells you something. More sophisticated players are not only asking, do I want to be long or short? They're asking, how much movement am I being paid to tolerate? There has also been repeated evidence in recent months of demand for downside protection in options markets. That does not guarantee a fall, but it does tell you professionals have not been treating risk as imaginary. So, what does that mean for the chart in front of us? It means this is not the time to reduce the analysis to one candle or one indicator. We need a stack of evidence. Support loss, weak retest, downside structure, channel failure, momentum deterioration that actually persists. If those pieces begin lining up together, then the case for another major leg lower becomes much more serious. One signal is a caution light. Several signals together can become a traffic stop. Now let's talk about the upside side, because this is where balanced analysis matters. If Bitcoin pushes decisively back above the nearby resistance area, around the upper 70,000 to roughly 80,000 region, and if that move comes with a stronger upward sequence rather than another shallow bounce, then the bearish continuation case gets delayed. Not erased forever, delayed. The market could then press toward higher resistance and force bears to wait for a cleaner setup. That is the part many bearish traders do not want to hear, but they need to hear it. I mean, think about it. If the next major drop were already fully confirmed, the market should not be reclaiming key resistance with strength. It should be failing faster. It should be attracting sellers sooner. It should be unable to rebuild above broken levels. If instead buyers absorb the selling, force a reclaim, and begin printing a healthier sequence of higher lows, then the market is telling us the correction has more room. Again, not necessarily a new bull phase, but certainly not a finished downside signal either. This is why I keep separating prediction from confirmation. Prediction makes for louder thumbnails. Confirmation makes for better decisions. It is tempting to call the exact top, the exact bottom, the exact next crash, the exact next squeeze, but markets rarely pay you for dramatic certainty. They pay you for staying aligned with changing evidence. And one of the most dangerous environments is a rebound that keeps stretching just enough to exhaust both sides. Bulls get shaken out by sharp pullbacks. Bears get squeezed by fresh highs inside the recovery. Day traders overreact to every small move because the larger direction feels unclear. That is not an accident. Choppy corrective markets create emotional fatigue. People eventually trade because they are tired of waiting, not because the signal improved. That is a terrible reason to risk capital. If you're successful, share your success story in the comments so others can stay motivated. Now, let me bring in the historical side without pretending history repeats neatly. In prior Bitcoin cycles, there have been moments where the market rallied back into major technical reference points, looked better temporarily, and then rolled over later. There have also been moments where those same reference points were pierced before the real decision arrived. That is why I do not want to overstate the 200-day moving average, or a Fibonacci zone, or a single momentum reading. They matter as context. They matter as pressure points. But Bitcoin has a habit of overshooting obvious lines just enough to force emotional mistakes. So, if price pushes higher into a broader resistance pocket, do not automatically assume that invalidates the downside case. But also do not automatically short every touch because a chart line is nearby. Ask the better question. Is price accelerating through the zone or stalling there? Are pullbacks getting bought aggressively, or are rebounds getting sold quickly? Is volume behavior confirming participation, or is the move drifting on thin enthusiasm? Those questions are more useful than trying to sound certain too early. And let's flip it. If Bitcoin dips below support, do not declare victory for the bears after one quick move. The follow-through is what matters. Does price stay below the level? Does a retest fail? Does the broader market backdrop remain fragile? Do equity risk assets also begin to soften? Bitcoin does not trade in a vacuum. When the wider appetite for risk deteriorates, weak crypto structures can break faster. When broader risk sentiment stabilizes, even damaged charts can bounce harder than expected. That cross-market piece deserves more attention. Inflation remaining sticky, the central bank staying cautious, and volatility products becoming more prominent all point to a market that is still arguing about the price of risk. In that kind of environment, Bitcoin can absolutely rally, but rallies need to work harder. They need to prove more. Easy upside belongs to easy liquidity. This is not an easy liquidity setup right now. So, what specifically confirms the next major drop? First, a decisive loss of the lower support shelf, roughly in the middle portion of the 70,000 range. Second, a failure to reclaim that breakdown on the bounce. Third, a clear downside sequence that looks impulsive rather than corrective. Fourth, a break of the recovery channel that actually holds below. And fifth, continued inability to regain the nearby resistance region overhead. If those line up, the market is no longer merely warning, it is confirming. What delays that drop? A strong reclaim of resistance near the upper 70,000 region and roughly 80,000. A better upward structure. A market that starts turning lower highs into higher lows. A recovery that holds instead of fading immediately. If those things appear, then the correction may still be unfolding sideways or upward before any larger decision. That does not make bears wrong in the long term. It means the timing is not mature yet, and that timing point is everything. Being directionally right but early can still hurt. If you have ever been on the correct side of a big thesis but entered before the market confirmed it, you know exactly what I mean. The market can move against you long enough to shake your confidence, your risk management, and sometimes your account, even if the eventual idea later plays out. So patience is not weakness. Patience is position protection. I also want to say this carefully. Bitcoin's structural story remains bigger than one chart setup. There is still institutional involvement. There is still product expansion. There is still a global audience paying attention. But none of that prevents cyclical declines. Strong long-term narratives do not eliminate medium-term drawdowns. In fact, markets with the strongest stories often produce the most painful resets because conviction stays high while positioning gets crowded. That is why the next move matters so much. If Bitcoin cannot retake the nearby resistance zone and instead starts breaking key support with proper follow-through, then the market may be transitioning from a tired rebound into a more serious downside phase. If it regains control, the next drop thesis needs more time. Either way, the chart is asking for confirmation now, not blind allegiance. So, here's the bottom line. Bitcoin is not giving us a completed crash signal yet, but it is sitting close enough to important levels that confirmation could arrive quickly. The bearish case gets stronger with support failure, weak retests, impulsive downside, and channel breakdown. The bullish short-term case improves with a decisive reclaim of resistance and a healthier upward structure. Until one side proves more, do not let impatience manufacture certainty for you. And just so we're clear, this is education, not financial advice. I'm walking through market structure, risk signals, and decision points so you can think more clearly, not telling you what to buy, sell, or hold.